Listen, I want you to picture something real. It is a Tuesday morning in May 2026. The kitchen smells like the coffee Tom made 20 minutes ago in the same Mr. Coffee machine he and his wife bought at a Sears clearance sale in 1998. Tom is 64 years old. He's sitting in the breakfast nook of a modest brick ranch outside Charlotte, North Carolina, the kind of house that has been paid off since the second Bush administration. And the paint on the back porch railing is starting to peel because Tom's knees have been telling him for 2 years that he is done climbing ladders. On the table in front of him is a manila envelope from the Social Security Administration. He just opened it. Inside is a statement that says his current monthly benefit, the one he started taking the month he turned 62, because his regional sales manager job ended 6 months earlier than he expected, and the COBRA was costing him $1,100 a month, is $1,946. And next to that statement is a 1099 SSA from the prior tax year. And underneath that is a letter from the IRS noting that his combined income for 2025 exceeded a specific threshold and a portion of his Social Security benefits, the same benefits the lady at the SSA field office told him in 2024 were tax-free for most retirees, are now being taxed at the upper double digits. Tom does the math on the back of an Office Depot envelope with a big pen his granddaughter Madison left there last Thanksgiving. He stares at the number. He stares at the wedding ring on his hand, the one he has worn since 1986. He stares at the photograph on the fridge of him and Linda at the Outer Banks the summer before her stroke, and he realizes, sitting alone in that kitchen, that the decision he made at 62 to start collecting, because he was tired and the layoffs were rolling, and the financial guy in the navy blazer at the credit union said, "Well, it is your money. You might as well take it." That decision is going to cost him over the rest of his life, somewhere in the range of $50,000. Not a typo. $50,000. And that is the conservative estimate. The aggressive estimate, the one his nephew, the CPA, ran on a spreadsheet over Thanksgiving and refused to email him because he didn't want to ruin Christmas, is closer to $72,000. Tom puts the pen down. He looks out the window at the bird feeder Linda used to fill with the safflower seed the Cardinals like. And he says out loud to nobody at all, in a voice that has no anger in it yet, just a kind of slow dawning. He says, "Nobody told me this." That is the trap. That is the entire video. That is the warning that nobody at the Social Security office gave Tom, that nobody at the financial industry conference gave the Navy blazer guy to pass on to Tom, that nobody in the 4 hours of pre-retirement seminars at the Regional Civic Center mentioned even one time. My name is John, and for 3 decades I sat on the inside of the system that did this to Tom and is right now, this morning, doing it to approximately 300,000 to 400,000 Americans who are about to claim Social Security at 62 in 2026. I was forbidden by employment contract and by industry custom and by a certain professional cowardice. I am no longer interested in defending, to say out loud what I am about to say in this video. So I am saying it now. If you are 60, 61, 62, 63, 64, or 65 years old, and you have already claimed Social Security at 62, or you are seriously considering claiming it in the next 18 months, you need to watch this entire video before you sign one more piece of paper. The IRS treats you differently than the person who waited. Not slightly differently. Catastrophically differently. And the difference, on average, over the rest of your life, is the $50,000 reduction trap. Stop the video right now. I want you to do one thing. Before I walk you through the math, before I show you the 3 layers of this trap, and the 4 moves that can still save you even if you already claimed, I need you to hit the like button. I do not say that the way the kids on TikTok say it. I say it the way a man who has watched the algorithm suppress senior financial content for 6 straight years says it. The platform in 2026 has a documented bias problem against videos that warn Americans over 60 about exactly the kind of trap I am about to describe. The friendly commercials with the silver-haired couple kayaking through a sunlit lake, those get pushed. The video that tells you the kayak couple is making a $50,000 mistake, that one gets buried. Hitting like is the act of pushing this video to one more father, one more uncle, one more widow who is sitting in her own kitchen this morning with her own SSA envelope and her own slow dawning realization. Then subscribe. Then hit the bell, the little bell next to the subscribe button, so that the next time I publish a warning, The algorithm cannot quietly forget to show it to you. If you are watching this on the TV through the Chromecast and your spouse is in the other room, pause for a second. Pick up the phone and do it from the phone. And while we are here, the suits in the legal department want me to remind you, the way they remind me every time I sit down to record, that this is not financial advice, this is not tax advice, this is not legal advice. This is a survival guide for the working American over 60 who is being engineered out of his own retirement money by a tax code that has not been adjusted for inflation since the year Reagan started his second term. Like the video. Subscribe. Drop a comment with your age, your state, and the year you claimed or are planning to claim Social Security. I read every single one. Let us go. Here's the dirty little secret that the Social Security Administration has been hiding in plain sight for 43 years. When you file for Social Security at age 62, you are not just accepting a smaller monthly check. You are entering a separate tax universe. The IRS, by statute, by code section, by the explicit design of the 1983 Greenspan Commission amendments and the 1993 Clinton-era expansion, treats early claimants under a different formula than people who waited. And that different formula has 3 layers. I'm going to walk you through each one slowly with real 2026 numbers. The way I used to walk through it for the people who paid the firm $700 an hour to sit on a leather chair in our conference room and hear it. Layer 1, the permanent benefit reduction. This is the layer everybody half knows. If your full retirement age is 67, which it is for every American born in 1960 or later, and you claim at 62, your monthly benefit is permanently reduced by approximately 30%. Not for 1 year, not until you turn 67, for the rest of your life, and then for the rest of your surviving spouse's life if she takes a survivor benefit based on your claim. Let me give you the math the way Tom should have had it explained to him. If Tom's primary insurance amount at full retirement age would have been roughly $2,780 a month, his benefit at 62 is roughly $1,946. The gap is $834 a month. Multiply $834 by 12 months. That is just over $10,000 a year, every year, for the rest of his life. Tom is in good health. His father lived to 88. His mother is alive at 86. Tom is statistically likely to live to 84 or 85. From 62 to 85 is 23 years. 23 years of giving up roughly $10,000 a year. That alone, just layer 1, is somewhere north of $230,000 in lifetime benefits left on the table. But that is not the $50,000 reduction trap. That is the headline number that gets quoted on the cable news segments. The trap is what happens on top of that in the tax code after the permanent reduction is locked in. Layer 2, the earnings test clawback. Here's the part nobody told you when you were celebrating the first deposit hitting the checking account. If you claim Social Security before your full retirement age of 67, and you continue to earn wage income, whether from a W-2 part-time job or a 1099 consulting contract, the Social Security Administration applies what is called the Retirement Earnings Test. In 2026, the threshold sits at approximately $23,400 a year. Above that threshold, the SSA deducts $1 of benefits for every $2 you earn over the limit. Not 1 in 3, not 1 in 5, 1 in 2, 50%. And here's what the Navy Blazer guy at the credit union did not mention to Tom. Tom took a part-time consulting gig with his old employer in 2024 to bridge the gap while he figured out his next move. He earned $52,000 from that consulting work. The earnings test applied. Tom forfeited, that 1 year, approximately $14,300 in Social Security benefits. He did not get those benefits later. He did not get them back at full retirement age, at least not in any meaningful way that recouped the cash flow he had counted on. Yes, there is a recomputation at full retirement age that adjusts his benefits slightly upward for the months he forfeited, but the recomputation is a fraction of a percentage point a year. And for Tom, who is now 64, it adds back a few dollars a month for the rest of his life. The math on the recomputation, run honestly, recovers somewhere in the range of 18 to 22% of what was forfeited, depending on longevity. So Tom's $14,300 in lost benefits, after the recomputation, cost him a net of roughly $11,000 to $11,700. That is layer 2. And it happens on average, for the early claimant who keeps working, in 3 out of every 5 cases I've seen in 3 decades of practice. Layer 3. This is the layer the IRS designed. This is the engine of the $50,000 reduction trap. This is the part of the tax code that has not been adjusted, not by one single dollar, since 1983 when it was written, and 1993 when it was expanded. It is called the Provisional Income Calculation for Social Security Taxation. Let me tell you what actually happens mathematically, word by word, so you understand the size of the crime. The IRS adds up your adjusted gross income, plus any tax-exempt interest, plus 1/2 of your Social Security benefits. That total is your provisional income. For a single filer in 2026, if your provisional income exceeds $25,000, up to 50% of your Social Security benefits become taxable. If your provisional income exceeds $34,000, up to 85% of your Social Security benefits become taxable. For a married couple filing jointly, the thresholds are $32,000 and $44,000. Look at those numbers: 25,000, 34,000, 32,000, 44,000. Those are the exact same numbers that were written into law in 1983 and 1993. They have never been indexed to inflation, not once. Not by the Reagan administration that signed them, not by the first Bush, not by Clinton, not by the second Bush, not by Obama, not by any administration since. 43 years of inflation, and those thresholds have not moved by a single penny. In 1983, $25,000 in provisional income was roughly the equivalent of $80,000 in 2026 dollars. The threshold was designed to catch only the wealthiest 10% of Social Security recipients. Today, it catches roughly 56% of recipients, including, I want you to hear this, including retirees living on a combined income of $36,000 a year between Social Security and a modest IRA withdrawal. Here is the dirty math. Tom, the man in the kitchen, drew $24,000 from his traditional IRA in 2025 to pay off the new HVAC unit and cover the property tax bill and replace the transmission in Linda's old Subaru. His Social Security benefit for the year was $23,316. His provisional income calculation: $24,000 IRA withdrawal, plus 0 tax-exempt interest, plus half of $23,316, which is $11,658, totals $35,658. Tom is a widower, filing single. His provisional income is over $34,000. 85% of his Social Security benefit, $19,818, is now taxable as ordinary income. Tom's marginal federal tax bracket after the standard deduction and the senior bonus deduction that was added in the One Big Beautiful Bill of 2025 sits in the 12% range. He pays an extra $2,378 in federal income tax that year, solely because of the Layer 3 trap. Not because he is rich, not because he withdrew too much, because he made the choice at 62 to start his Social Security check, which forced a higher provisional income calculation every single year for the rest of his life in a tax code with frozen thresholds. Over 22 years of retirement, Layer 3 alone cost Tom, conservatively, somewhere in the range of $48,000 to $54,000 in extra federal income tax he would not have paid if he had waited until 67 to claim. That, friends, is the $50,000 reduction. That is the trap. Now I want you to know who built this. I do not say this in a partisan way. I do not name a single politician, because the truth is, every single American president since 1983 has had the opportunity to fix this, and not one of them has. Not one. The frozen provisional income thresholds were designed by the 1983 Greenspan Commission on Social Security Reform, a bipartisan body that recommended taxing Social Security benefits for the first time in the program's history as part of a broader package to keep the trust fund solvent. The recommendation became law under the Social Security Amendments of 1983. The thresholds were set deliberately high at $25,000 single and $32,000 joint, specifically so that only the wealthiest 10% of beneficiaries would be affected. The 1983 law contained no indexing provision, none. The drafters knew exactly what would happen over time. Inflation would silently pull more and more middle-income retirees into the taxation zone year after year, until the original 10% target became the majority of beneficiaries. This was not an accident. This was not an oversight. This was a revenue-generating mechanism designed to grow automatically, without any politician ever having to vote to raise taxes on retirees. In 1993, the Omnibus Budget Reconciliation Act added the second tier, the 85% taxation tier at $34,000 single and $44,000 joint. Again, no indexing. Again, deliberate. The Joint Committee on Taxation, which is the technical scoring body that runs the math for Congress on every major tax bill, has published, over the years, multiple working papers acknowledging that the frozen thresholds function as a stealth tax increase on the middle-class retiree. The most recent of those papers, published in early 2026, projects that by 2030, approximately 68% of all Social Security recipients will be paying federal income tax on at least a portion of their benefits, a figure that includes retirees whose combined income from Social Security and a modest pension does not exceed $45,000 a year. The committee has known, the Treasury has known, every administration has known. The default settings of the American Retirement Tax Code are calibrated for maximum government revenue, not for retiree protection. That is who built this. That is who refuses to fix it. And that is why, when the Navy Blazer guy at the credit union told Tom in 2024 that Social Security was tax-free for most retirees, he was repeating a 1983 sentence that has been technically true and functionally alive for the entire careers of every working financial professional in America today. All right, let us pause here for a second. I want you to do something for me because I want to know who is on the other end of this video. The comment section of this video is, for me, the field hospital. It is where the actual data comes in. The numbers the SSA puts out in their press releases are population-level averages. The numbers in the comment section are the lived reality of the American retiree in May 2026. So here's what I want you to do. Drop a comment below with 3 things. 1. Your age right now. 2. The state you live in. Because the state-by-state interaction with Social Security taxation is something I'm going to walk you through in the regional section in a few minutes, and I want to know where my listeners are. 3. The year you claimed Social Security, or, if you have not yet claimed, the year you are planning to. That is it. 3 things. Age, state, claim year. I read every single one. I do not have a team of interns. I do not have a virtual assistant in the Philippines reading them for me. I sit at the kitchen table on Sunday mornings with a cup of black coffee, and I read the comments from the previous week, and I make notes for the next set of videos based on what you tell me is happening to you. The comment section is where I find the next Tom. The comment section is where I find the widow in Akron who got hit with the survivor benefit cliff. The comment section is where the field reports come in. Drop yours, then keep watching, because the next section is the part that can actually save you money this year. Now we get to the part that matters. Knowing the trap is the easy part. Escaping the trap, especially if you already claimed at 62, is the hard part. But I want you to understand something before I walk you through the 4 moves. There is a version of every single one of these escape hatches that is still available to you in 2026 if you are willing to act in the next 90 to 180 days. None of these moves are theoretical. None of them require you to be wealthy. None of them require you to hire a $400 an hour lawyer, although I am going to be honest with you. 2 of them work better if you sit down with a credentialed CPA for 1 billable hour, which in 2026 runs you somewhere in the range of $250 to $400, depending on the market. That hour will, on average, return between $8,000 and $30,000 over the rest of your life. That is the math. Move 1. The 12-month do-over. The Social Security Administration has, in Section 4.640 of its regulations, a provision called the Withdrawal of Application. It is filed using Form SSA 521. If you claimed Social Security within the last 12 months, you can withdraw your application, pay back every dollar of benefits you have received, and reset the clock as if you never claimed at all. You can then reclaim later at full retirement age or at 70 at the higher monthly benefit. The catch is the 12-month window. If it has been 13 months since your first check, the door is closed, permanently closed. So if you are watching this video and you claimed Social Security in May, June, July, August, September, October, November, or December of 2025, or any time in 2026, the do-over is on the table for you. If you claimed in March of 2025, you have 8 weeks left. If you claimed in October of 2024, you missed it, and you go to move 2. Let me show you the math. Linda is a 63-year-old widow, suburban Tampa. She claimed her own retirement benefit at 62 in June of 2025 because her late husband Robert's pension had a non-survivor structure she did not understand until after he passed. She is 11 months into her benefit. Her monthly check is $1,612. She has received approximately $17,732 in Social Security since June. She has a modest IRA of $340,000 and the paid-off home she and Robert bought in 1991. Linda hires a CPA in March 2026. The CPA looks at her numbers and says, "Linda, here is the play. We file SSA 521. We pay back the $17,732 over the next 60 days. We bridge your income from now to your full retirement age of 67 using a tax-efficient withdrawal strategy from your IRA. At 67, your benefit, based on your full primary insurance amount, will be approximately $2,303 a month instead of $1,612. That is a permanent increase of $691 a month, $8,292 a year, every year for the rest of Linda's life. Linda's mother is 89 and still living independently in the Villages. Linda is likely to live to 87 or 88. The do-over gains her, over her remaining lifetime, somewhere in the range of $190,000 to $215,000 in additional Social Security benefits, plus a lower lifetime provisional income calculation that reduces her Layer 3 tax exposure by roughly $14,000 over the same period. The cost is one Form SSA 521, the repayment of $17,732, and 1 billable hour of CPA time. Total cost, round numbers, $18,200. Total lifetime gain, round numbers, $210,000. That is move 1. If you are inside the 12-month window, this is the single most powerful move available to you, full stop. Move 2. The voluntary suspension at full retirement age. If you miss the 12-month do-over, you have a second escape hatch, and it sits at your full retirement age of 67. Under current Social Security regulations, the Bipartisan Budget Act of 2015, restrictions notwithstanding, you can request a voluntary suspension of your benefits at any month between full retirement age and age 70. During the suspension period, you do not receive a check. But here's the part that matters. Your benefit accrues delayed retirement credits at the rate of 8% per year for every year you suspend, up to age 70. 8% guaranteed by federal law. There is no investment product in the legal American financial industry in 2026 that pays a guaranteed 8% annual increase with zero market risk. Not one. So if you are 64 right now and you claimed at 62, you can let your benefit run for the next 3 years until you hit 67, then suspend until 70. And your benefit at age 70 will be approximately 24% higher than your benefit at 67, which is already higher than the reduced amount you are receiving now. The math is not as good as the do-over because you locked in your 30% permanent reduction at 62, but it stacks delayed retirement credits on top of the reduced base, which still produces a meaningful improvement. Tom, the man in the kitchen, is 64. He missed the do-over. He claimed at 62 in 2024. His current benefit is $1,946. If he does nothing, his benefit at 70 will be approximately $2,028 with cost of living adjustments. If he suspends from 67 to 70, his benefit at 70 will be approximately $2,510. That is an additional $482 a month, $5,784 a year for the rest of his life. Over 15 more expected years, that is roughly $87,000 in additional benefits, minus the 3 years of forfeited checks from 67 to 70, which net out to roughly $54,000 in lifetime gain after the suspension cost. Not as good as Linda's do-over, but still a meaningful escape from the Layer 3 trap. Move 3. The Roth conversion ladder before and during early Social Security years. This is the move the financial industry will not tell you about because it does not generate a commission. The traditional IRA is the engine of the Layer 3 trap. Every dollar you withdraw from a traditional IRA after age 59 and a half counts dollar for dollar in your provisional income calculation. The Roth IRA does not. Roth withdrawals after the 5-year rule and after 59 and a half are not counted as taxable income, are not counted as adjusted gross income, and are not counted in provisional income. They are invisible to the Social Security taxation formula. If you have a traditional IRA balance and you are in the gap years between 60 and 67, you have a window narrowing every year to convert chunks of your traditional IRA into a Roth IRA at the current tax brackets, which were scheduled to sunset at the end of 2025 under the TCJA expiration provisions that Congress in the One Big Beautiful Bill of 2025 only partially extended. The 12% and 22% brackets, for now, remain favorable through 2026 and 2027. Conversions done in those years lock in the lower bracket. Conversions done in 2028 or later, if the sunset takes full effect on the parts Congress did not extend, will likely be done at higher marginal rates. The window is narrower than you think. Ed, the 69-year-old in Phoenix with the $1.1 million traditional IRA, ran the math with his CPA in late 2025. They identified $54,000 a year of conversion headroom that kept Ed in the 12% bracket. They are converting that amount in November of each year for the next 4 years. By the time Ed turns 73 and his required minimum distributions kick in, his traditional IRA balance will be roughly $620,000 instead of $1,180,000. His required minimum distribution will be roughly $23,000 a year instead of $44,000. His provisional income will be approximately $22,000 lower every year. His Layer 3 Social Security taxation will drop from 85% of his benefit to roughly 50%. The lifetime savings, conservatively, somewhere north of $60,000. Move 4. The withdrawal sequencing rewrite. The default sequence the financial industry teaches is spend taxable accounts first, then traditional IRA, then Roth. This is wrong for the early Social Security claimant. The correct sequence for someone trapped in Layer 3 is to draw from Roth first to keep provisional income low, then taxable accounts for the years you have headroom, then traditional IRA only in years where you need to fill the bracket. This single change in withdrawal sequencing, executed for 15 years of retirement, reduces lifetime Social Security taxation by an average of $11,000 to $19,000 for the moderately funded retiree. It is invisible. It requires no new account. It requires no advisor fee beyond the initial hour to set up the sequence. The man who walked into my office 22 years ago with a yellow legal pad and 3 IRA statements left 90 minutes later, having saved his wife, who he buried in 2019, an additional $34,000 in lifetime federal income tax solely because we resequenced the withdrawal order before he claimed Social Security at 64. That is the kind of math nobody is showing you on cable. Now I want to walk you through 3 states because the Layer 3 federal trap interacts with state income tax in ways that surprise even the people who think they have done their homework. Florida. If you live in Florida, the state does not impose an income tax. None. 0. Your Social Security benefit is taxed only at the federal level. For the Tampa widow Linda, this means her entire Layer 3 exposure is the federal calculation I walk through, and her state liability on Social Security is 0. Florida also has the homestead exemption that protects a meaningful slice of assessed value on the primary residence from property tax, and the Save Our Homes assessment cap that limits annual increases on the homestead to 3%. The interaction matters because if Linda continues to draw from her IRA to bridge to her full retirement age, those withdrawals do not generate a state tax bill in Florida. The same withdrawal executed in Ohio would. Ohio does impose a state income tax. Social Security benefits, however, are exempt from Ohio state income tax under Ohio Revised Code. Section 5747.01. That is the good news. The bad news is that traditional IRA withdrawals, pension income, and 401k distributions are fully taxable at the state level, with the top rate sitting in the upper 3% range in 2026 after the recent bracket consolidation. For Tom, hypothetically relocated to Cincinnati for this example, the Layer 3 federal trap on his Social Security is the same, but his $24,000 IRA withdrawal generates an additional state tax bill of roughly $560 a year. Over 22 years, that is approximately $12,300 in additional state tax that Linda in Tampa does not pay. The Ohio retiree also faces a joint filing credit and a senior citizen credit that partially offset the burden, but the offsets are modest, totaling somewhere in the range of $200 a year. California. California is the third leg, and it is the worst-case scenario for the early Social Security claimant. California, like Ohio, exempts Social Security benefits from state income tax under California Revenue and Taxation Code, Section 17,087. That is the good news, and it is the entire good news. California fully taxes traditional IRA withdrawals, pension income, and 401k distributions at marginal state rates that climb from 1% at the low end to 13.3% at the high end, with the middle-income retiree typically landing in the 6 to 9.3% bracket. For an early Social Security claimant like Carol, a 73-year-old in Sacramento drawing $32,000 a year from a traditional IRA, the additional California state tax on the IRA withdrawal alone runs roughly $1,920 a year. Over 14 expected remaining years, that is approximately $26,800 in additional state tax. Combine the California state tax burden with the federal Layer 3 trap, and a Sacramento retiree with the same income profile as a Tampa retiree pays roughly $41,000 more in lifetime taxes, purely because of the zip code. None of this is in the brochure the financial industry hands you. None of this is in the commercial with a kayak couple. The default settings of the American retirement system are calibrated for maximum government revenue at every level, federal and state, and the early Social Security claimant in a high-tax state is the most efficient revenue source the system has. I want you to do one more thing right now before I close out this video. Pull out your phone, open this video on the YouTube app, hit the share icon, the little arrow pointing right at the bottom of the screen, and send this video to one person. Not 5, not 7. 1. Pick the right one. I want you to think about the widow in your life who refuses to talk about Social Security because she thinks she already missed the boat at 62. I want you to think about the retired teacher down the street, the one who keeps saying she will deal with it next year. I want you to think about your brother-in-law, the retired tool and die guy who claimed at 62 in 2023 because the shop was downsizing, and who has no idea that the $50,000 reduction is silently working against him every single tax year. Send this video to that one person, one text message, one sentence. Hey, watch this when you get a chance. It explains something I didn't know either. That is it. One conversation now, started by you, saves them somewhere between $14,000 and $80,000 over the rest of their life. The do-over window for them might be closing in 60 days. The Roth conversion window might be closing in 14 months. The voluntary suspension move at full retirement age might be the only escape they have left. They do not know any of this. You now do. Send the video. Save the friend. I want to close this video the way I open every one of these warnings. The system is patient. The system is waiting. The IRS has built the Layer 3 trap to harvest revenue from middle-class retirees who did exactly what the financial industry told them to do, which was claim Social Security at 62, draw from the traditional IRA to bridge the gap, and assume the tax code would be reasonable about it. The tax code is not reasonable. The tax code is calibrated. The frozen provisional income thresholds will not be unfrozen in 2026, will not be unfrozen in 2027, and based on the working papers the Joint Committee on Taxation has been publishing for 2 decades, will not be unfrozen ever. They are too valuable as a stealth revenue mechanism for any administration to give up. The window for the do-over closes 12 months after your first check. The window for the Roth conversion at the lower brackets is narrower than you think. The clock is ticking right now, in the kitchen, in the recliner, in the chair next to the bird feeder where you are watching this. There is no version of this where waiting helps you. If you have already claimed at 62, you have today to look at the calendar and count the months. If you are 60 or 61 right now, you have today to sit down at the kitchen table and run the 4-move math on the back of an Office Depot envelope the way Tom did, with the Bic pen your granddaughter left there last Thanksgiving. Save this video, bookmark it, add it to your private library. This is your survival manual for one of the cruelest stealth tax mechanisms ever written into American law. Like the video, subscribe, hit the bell, drop your age, your state, and your claim year in the comments. Share with the one person who needs to see this before their own window closes. Then call a CPA, not the financial guy in the navy blazer, an actual credentialed CPA, today, this week, before the next quarterly tax cycle locks you into another year of the trap. The IRS treats you differently when you claim at 62. The IRS has built the math to make that difference cost you $50,000. You know now. Go act like a man who knows. Stay sharp, stay angry, and protect what is yours before the system gets the chance to.